This video is part of a 6-video series based on a presentation I did at a real estate conference in Los Angeles in 2022. Make sure you watch the whole series. There's a lot of information in there. Oh, but it's not a good time to buy. The interest rate is too high. It is a good time to buy. The interest rate is not that high. Right? The average over the last 30 or 40 years, the interest rate has been, about 7.75. Right? So we've seen much higher interest rate. We're just getting back to like normal rates. It's probably going to go a little bit higher, and then it's going to kind of hopefully stabilize to something a little bit more normal. But that's kind of what's going on right now. So it's still a good time to buy and get investing in real estate in general and use leverage. In fact, when we bought our first house, I think, what was the interest rate on our first house? 17%. You see? And we're fine. Look at us. We survived it. So money is kind of a little bit of an illusion, right? So that piece of paper is it's kind of not real. It's especially these little numbers on the computer when you look at your bank statement. It's like, I don't know. And the reason why I'm saying this is that the reason why this is money and this is real it's kind of not real is because it works because we all agree that it has value. That if you're giving me this, that means that I can turn around and I can use this piece of paper to buy something I really want, right? And in fact, even on this, they say, in God we trust, which means I hope to God it's worth something, because and they put all kinds of symbols in that and pyramids and so, wow, that makes it real. But the other thing too that's a little bit different is about money is inflation. When the inflation is like 2, 3, 4%, we don't realize how it's affecting our purchasing power. But now everybody's talking about inflation now because 8%, we can feel it, we can see it. Last month when you bought your whatever you bought at the grocery store, you could see the difference in prices. So that's unbelievable. So that's why here I'm going to show an example here of, again, why it is important to invest in real estate and the difference. So let's say this, you have $25,000 today, and we're going to look at, and you decide to put that money safely in your drawer. This is exactly what happened. In a bad economy, as we're heading into a recession, what do people do? They kind of clam up. They don't want to take risks. And the fact that they're doing this is risky. So you want to be able to really think about this. Again, I'm focused on numbers here. So $25,000 you put in your drawer because you're scared, and then 5 years down the road, this is what's going to happen. You can buy today 5,000 coffees with your $25,000. I know it's a lot of coffees, but I drink a lot. $5, right? And then assuming 5.4% inflation, we're at 8% inflation. I'm assuming that over the next 5 years, it's going to be only 5.4% average per year. Your cup of coffee is going to be worth $6.50 5 years from now. That means you can buy 3,800 cups of coffee. You're losing purchasing power just by doing that. So of course, the thing is that you have to make money work for you. And this is why it was so upsetting for me to watch my equity watch TV all day. I needed this equity to work for me. All right, same thing here, same example, but we're going to do something different. We're going to buy a rental property, $100,000 property, down payment, 20% down payment, and we're going to throw away $5,000 in closing costs. So you agree with me, we're taking $5,000 and we're giving it to the bank. Thank you and the bank and escrow and all of that, just to be able to buy this property. So we're kind of starting $5,000 lower here in terms of equity, right? So this is our $25,000. We have $80,000 loan, and our equity is $20,000. If we were not doing this deal, we would still be able to buy the 5,000 cups of coffee. So $1,000 rent, I'm using kind of like the same 1% rule, mortgage payment, other costs, and then we have cash flowing, $240. So a little bit high, but it's good. Interest rate 7.5%, 5.4% inflation, appreciation on the property 3%, And then rental increase, 5% totally feasible in a landlord-friendly state. So this is kind of where we are. So these things affect the numbers very differently. Appreciation, the 3% appreciation, affects the house prices, the whole house prices, not just your $20,000 in down payment. Affects you're growing that house at 3%. The rent is going up at 5%. The mortgage payment is it increasing? Same mortgage, the whole time. Other costs, I'm assuming that the costs also increase by inflation rate. So over this time period, what's going to happen is that your net cash flow is actually going to go up during that time period. So fast forward 5 years later, house appreciated $15,000. Total balance of the loan, because now your tenant has been paying the mortgage all this time and pays down the loan. So now you owe, instead of owing $80,000, you owe $75,000. Total equity, $40,000. You started with 20, you doubled your equity. Accumulated net cash flow. So this is all the increase, and somehow you didn't invest any of that money. You could have, but you didn't. You just put it there. So $19,000. Now the total value of this investment is now worth $59,000. Now how many cups of coffee? It's all about coffee. How many cups of coffee? 9,000 cups of coffee. You've actually increased your purchasing power.